Well, I think the first thing to remember about ESG is it's taken the investment world by storm in the way that smart beta took the investment world by storm. This is a driven political marketing message that captures people's imagination in an area where the financial institutions traditionally operate, which is how do I separate the client from his money to my benefit and present it as being to his benefit. Now, historically, the fund manager gave you the returns and you didn't bother looking too much at what the fee he was charging was, because that was the process. ESG is occurring as a theme at a time when it's never been easier to access investment opportunities. What I mean by that is you can go onto your smartphone, you can go onto your computer tablet, you can go onto a phone line, and literally within 10 minutes you can set up an ISA, or you can set up an investment vehicle through which you then say, and I'd now like to invest in this way.
Yeah.
The average investor doesn't know when to buy a stock. On the retail side, the average investor doesn't know when to buy a stock and certainly doesn't know when to sell a stock unless somebody tells them. Most people take the guidance. They might read it online. They might read it on a Wall Street Bets account. They might, who knows where they're going to get their decision-making information. But the idea of ESG is actually, it's about saying, I want to select from a group of stocks that meet certain criteria, however ethical you want to categorize that. It is not something where you can easily evaluate how good or bad your ESG score is to determine how good or bad a return you're going to get as an investor. So the ESG information data is part of your investment process, and we shouldn't treat it as the investment process in and of itself. I would look at ESG and say, for example, the S&P 500 has an ESG S&P 500 equivalent, and it tracks the S&P and it slightly outperforms it. People go, oh, good, I can invest in that. What you're really doing here is investing in 300 instead of 500 stocks. And how do they get those 300? Well, once you've thrown out a few defense contractors and tobacco companies and oil stocks, the big challenge you've got is that the oil sector is the easy winner for not being invested in ESG. And a lot of people invested heavily in tech and not invested in oil. That's been a good result. Except now, Chevron's giving you a 5% yield and it's still making huge cash flow generations. And at the other end of the spectrum, everybody in ESG was investing in Tesla, who doesn't really make any money. Right. So you're now seeing people say, oh, well, I'm not going to invest in Tesla because Elon Musk has now just bought some Bitcoin and Bitcoin isn't ESG. So I can justify dropping Tesla from my ESG fund because it's not really ESG after all. And you start thinking to yourself, are we now beginning to justify what we want as ESG to protect our investment returns? Or are we really saying ESG is one of the decision-making factors about investing in companies that should otherwise give me a return? So my approach to ESG is to say, look, it's absolutely correct that you can make a judgment. Do you want to have ESG stocks? Fine. There's plenty of stocks that can fit into that category, but you can also make a decision, is it E, is it S, or is it G? These are just bundled together, actually as much as a marketing pitch as anything else. But by bundling those signals together, there's very little evidence that you can evaluate and then determine that these give a better investment return over and above the fact that they're all stocks everybody's buying. I'm buying Amazon because it's in the ESG category. Never mind that home delivery service is probably creating huge demands for fossil fuels and delivery costs and bad for the air pollution and all that stuff. What's your ESG criterion really about? Ultimately, investors are about getting a return on their money. And ESG has not had to answer that question for a while because it's had this tech bias and anti-oil stock bias, energy stock bias. But now you see those big oil companies making their big investments in green energy. Are they really the bad guys anymore? Well, we're going to start seeing people saying, oh, yes, we're allowing Shell in our ESG because its environment policies are so much better than the competition. So we're going to have one oil stock, or then we're going to have two. And you're going to start running out of reasons as to why ESG underperforms.
Yeah.
If you've got this switch to more value orientated investments that's going on right now, people investing in banks aren't in your ESG universe because banks are bad, but actually now banks have lots of, board members who are, meeting the right criteria. And so they're now meeting an ESG criterion. So if it starts to become this kind of movable feast to justify investment, it just becomes another investment theme, which, it's data, it's information, but I still want to make a proper evaluation of the thing that really counts when I'm an investor, which is, what does it future cash flow look like as an asset? What does that expected return I have putting my money in that asset?
If you'd like to hear this interview in its entirety, then head on over to SoundCloud, YouTube, Spotify, Apple Podcast, or any other major podcast platform and search Four Corners Podcast.